So let's look at a tax equity deal, and what do they get? What they do is they get a percent of the tax flows, which are, we would include taxes and the production tax credit in that bucket. And they also get a percentage of cash flow of EBITDA. And EBITDA is that. So remember when we divided up free cash flow is equal to EBITDA, okay, minus taxes plus the production tax credit. So what we're doing is they get percent of EBITDA, and they basically get a percent of the tax flows, which is the taxes plus production credit. So let's look at it. So let's look at a specific example that we can use to sort of demonstrate what's going on here. And let's assume we have a power project and has $1 billion in production tax credits with production, cost is $1 billion production. And tax equity investors are going to invest $400 million, and they're going to get 99% of the tax flows, 99% of the production tax credit. So these two things, again, 99% of those two things, plus 50% of the equity cash flows, EBITDA, for 6 years. What's left over, the residual equity, is going to invest $600 million, and they're going to basically get the residual cash flows after, which is total cash flows minus what the tax equity gets. Okay, so those are the two streams that we're going to look at. So there's one that goes to the tax equity investors, and there's another that goes to the equity investors. So let's look at how that shakes out. And so we need to look at what the flows are here. Okay, so what I've done here is, this is the EBIT from the project, which would be what's being generated in terms of income. Tax rate is 35%. So here's the taxes. Okay, NOPAT is this. Depreciation. Now, one of the things that is important about these projects is that typically they have a very accelerated depreciation schedule. So I've just sort of put in one here to demonstrate what's going on here. Okay, and we've got that. And then we have the capital expenditures, and then the production tax credit. This should be production tax credit, not PTA. Production tax credit is just $25 million per year for 4 years. And so I've just sort of made up these numbers. And basically we went through this. This would be the free cash flow that we have for the project. Okay, so now let's look at, I'm going to divide this up. I'm going to divide the free cash flows up into different buckets here, and where I'm going to have a bucket which is EBITDA. Remember, free cash flow is equal to this. Another bucket which is tax, another bucket which is production tax credit. So let's take the example that I had and divide it up into the bucket. And just to demonstrate, so I start with EBITDA. I put in taxes, what we had up above. I have the production tax credit. I add all of those up, and in year one it's 160, year one here is 160. So free cash flow is exactly the same under each one of these scenarios. Two things are equal, but what I've done is I've created three different buckets of cash flows. One is we're going to call cash flow, which is EBITDA. The other is taxes, and the other is the production tax credit. All right, so those are the flows we're going to look at. And so we're going to go back, and now let's figure out. All right, so let's sort of start with figuring out, given that, let's figure out what the cash flows are to the tax equity investors. All right, remember they get 99% of the taxes, 99% of the production tax credit, and 50% of the equity for equity cash flow, the cash flow for the first 6 years. So let's look at what that looks like. All right, here's what we got. And so they invest $400, and they get 99% of the taxes. So, okay, 99% of 35. They get 99% of 26. They get 99% of this. Okay, 99% of this, 99% of this, and 99% of this. They also get 99% of the production tax credit for that period of time. Now, what this means is, sort of look at this, and what it means is that what they're getting with the 99% of the taxes, the fact that taxes are positive up here, what that means that there's a tax shelter available okay, because of the negative the EBIT that's associated with it. So what we wind up with then is it's positive, positive, positive here, and then they start paying the taxes. Down here they get 50% of the equity flows, and the equity cash flows is the EBITDA. So they get 50% of the EBITDA, and this is this. So their total cash flows, they invest $400 million, and these are the cash flows that they receive. And what they wind up with is an IRR on their investment of 6.31. Now,